Long overdue for a global macro update. We'll get into Bitcoin, rates, and much, much more. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's video, we'll go through lots of charts on Bitcoin and interest rates, of course, the dollar, and the rest of global macro. I want to focus, however, on the Bitcoin price to begin. At TBL, we are building the best research product that we possibly can. And through that process, we are doing a lot of experimentation when it comes to crunching the numbers and applying a statistical model to Bitcoin. In a recent breakthrough, we have taken our TBL liquidity index and started to derive even more information out of it, just what you guys are asking for. Go to thebitcoinlayer.com/subscribe to become a TBL Pro today, and you can gain access to all of this research as it drops. But today, I want to give you guys a preview on what we are working on with TBL and crunching the numbers around Bitcoin. Now, you guys might already know we are using a proprietary index called TBL liquidity to give us an edge on the Bitcoin price as well as stocks. What we have discovered is that the Treasury market has a huge influence over the price of risk assets, including stocks and Bitcoin, and most specifically, bond volatility. And so that is the forward expectation of price movement and the variance of that price movement. And what we are doing is we are correlating high bond volatility, which means high uncertainty, with lower Bitcoin prices. We have seen that time and time again. We saw it most recently in early April. And since then, a dramatic fall in bond volatility, meaning an introduction of more certainty, less uncertainty, and that has buoyed the Bitcoin price as well as stocks. Now, we have derived over a 70% correlation with the Bitcoin price and our TBL liquidity index, and this is looking at trailing 12-month returns. However, lately, we have started to see that Bitcoin is moving not on this 4-year cycle that we've been used to, lining up with halvings and the mining reward being cut in half every 210,000 blocks, which is approximately 4 years. No, instead of that, we're seeing a quarterly cycle with the Bitcoin price, and more specifically with liquidity. So the Treasury market is seeing this quarterly behavior, and it's passing through to stocks. So the interesting and fascinating discovery that we had last week was that if we map this quarterly wave of liquidity coming in and out of the market, and we use that as a buy-sell trigger for Bitcoin, what we can actually do is, in a paper trade, outperform Bitcoin itself. Now, we are not offering investment advice or trading advice. What we are doing is our own research. And as an independent researcher that's not tied to an exchange or a company whose job it is to sell you Bitcoin, we can go both sides of the coin. That means when we see bullish conditions for Bitcoin, we can identify those, and bearish conditions, we can also identify those. And that's what we are going to continue to do for our TBL pros. Once again, thebitcoinlayer.com/subscribe to become a pro today. And now I want to give you a preview of some of those results of our early test of this paper portfolio. Using a $10,000 portfolio over the past 3 years, what we do here is that we are comparing both on the stock market in green and Bitcoin in orange. We are comparing a buy and hold strategy, which is in the dotted lines, to this trough to peak strategy, which what it does is it oscillates between a buy and a zero position on Bitcoin, and it uses the Treasury market as the leading indicator there. And what you can see here is that a slight outperformance in the stock market when we apply this strategy using TBL liquidity, and a significant, a material outperformance using or when we look at Bitcoin and using this TBL liquidity trough to peak strategy. So something very, very fascinating that we have uncovered. We will continue to crunch the numbers and we will share all of those results with you. Remember that this channel is a complement to our research platform. What we are trying to do is build out a set of tools for investors, and those set of tools can give them an edge when they are deciding how to allocate their assets. And this channel meant to be a complement there and give you guys the running narrative in the markets and give you a sense of what we are doing beneath the hood with our quantitative research. Stop asking how to value Bitcoin and start asking how to value everything else in terms of Bitcoin. A new report from Unchained and Strive reframes the way that we think about capital allocation and equity valuation. Repricing the economy in Bitcoin introduces a Bitcoin-denominated DCF model, discounted cash flow model, that changes how we value everything. Download the report at unchained.com/TBL. Unchained.com/TBL. Blockstream Jade Plus is the easiest, most secure way to protect your Bitcoin. Perfect for beginners and pros alike. With a sleek design, simple setup, step-by-step instructions, you'll be securing your Bitcoin in just minutes. Seamlessly pair with the Blockstream Green app on mobile or desktop for smooth onboarding. And if you want more security, Jade Plus supports multi-sig wallets with apps like Blockstream Green, Electrum, Sparrow, and Spectre. Protect your Bitcoin, sleep better, and stack harder. Use code TBL for 10% off. Go to store.blockstream.com. Use code TBL for 10% off. Do not write your seed phrase on paper. A lot of Bitcoin is lost forever, and poor seed storage techniques are a big reason why. This is why we use StampSeed, a DIY kit that enables you to hammer your seed words into titanium plates. You use professional stamping tools. These plates are heat resistant, rust resistant, and crush proof. They are compact and easy to hide, and most importantly, they will stand the test of time. Go to stampseed.com today and use code TBL to get 15% off of your order. A metric that you might be familiar with here is called the Mayer Multiple. This comes from Trace Mayer. This is a simple formula that uses a 200-day moving average and relates it to the current spot price. So this is a way of seeing where Bitcoin is relative to its average price. While Trace Mayer popularized it with Bitcoin, this is actually quite an old technique that traders use when they're trying to measure how hot or cold a market necessarily is. And what you can see here with Bitcoin at 104,000 approximately, we're recording this video on Monday, June 2nd. The block height is 899,581 as of this recording. And as of this recording, the spot price is closer to about 106,000. But on these snapshots, I have them at about 104,500. And what you can see here is that the 200-day moving average is all the way up at 94,000, almost 95,000. What that means is that our Mayer multiple, or the price to 200-day moving average ratio, is at 1.1. This is a very shallow valuation. Looking back on the bottom pane on this chart, looking back about a decade, what you can see is that 1 to 2 standard deviations above the mean is in the 1 1/3 to 1 2/3 area. Bitcoin currently at 1.1 is not even at its historical average on this Mayer multiple. This goes to show you here, it goes to show you that Bitcoin is not expensive relative to its trailing price. And that's another way of saying that the Bitcoin market has caught up to where the current spot price is. So a theme that you guys are probably familiar with at this point, if you've been watching, is that Bitcoin is not seeing these stretched valuations. Another way that we've described it is compressed volatility. You don't get that parabolic move that we're so used to seeing in Bitcoin. And look back at 2020 to early 2021. on this bottom pane, and compare that also to 2017. And that parabolic move in the Mayer multiple is another way to explain that the price is going up at an increasing rate above and beyond its trailing average price. And so we see right now no evidence of that whatsoever. That should make you bulls, especially you buy and hold bulls out there. It should make you feel very calm with a Bitcoin price above $100,000. It certainly makes me feel calm. The next one on valuation, MVRV, viewers and listeners will be very familiar with this ratio. It compares the market price to the realized price using that on-chain data to give us a sense of when coins were last moved on-chain and what the dollar price was at that time. We aggregate all of that data across the entire current supply of Bitcoin, which currently, as of right now, is 19.87 million coins. That's out of 21 million total coins that will ever exist. So we currently have 94.63% of all Bitcoin that will ever exist already in circulation. That 94.63% of Bitcoin to ever circulate, it has a date at which it is last moved, and more specifically, a block height. And that block height, each block height for the last 899,000 will save for several thousand blocks there at the beginning of Bitcoin's life when it didn't have a price because it didn't really have a network of users that knew and valued this new coin. When they did, you have about 850,000 odd blocks of price data. And we can take all of that price data and cross multiply it by the last moved coin. And what you end up with is an aggregate cost basis of the Bitcoin network. Today, that average cost basis is $46,600. And so that puts us at a current MVRV of slightly above 2. Looking back at some of these 1.5 standard deviation above the mean, that puts us at 2.25 to 2.5. So Bitcoin right now trading slightly above its historical mean on MVRV, but yes, significantly below its 1.5 standard deviation range. And then again, look back at 2017 and 2020, 2021, and you can see Bitcoin really got stretched on its valuation there. These are both ways of looking at valuation, but using very different methodologies. And it's interesting to see that, yes, these ratios do line up. A lot of it comes down to behavior. So yet another metric for you to observe to feel a little bit calm about where Bitcoin is on valuation. All right, let's get back to rates. We'll start with money markets and the Federal Reserve. I want to talk about interest rates and where the yield curve is here in a little bit. But the first thing that we have to start with is the Fed and Fed expectations, because what these are pricing in Fed expectations right now, it's pricing in an economy that is still doing absolutely just fine. Now, you remember we took our recession watch off, and we did that several months ago around the time of the election. And since then, there have been some recession scares. There has been media hysteria. We've covered that a few times. I still cannot believe the type of coverage that the current administration is getting, although the outlook for the current administration has certainly dimmed over the last few weeks as it has encountered more of a public spat with Elon Musk, as well as some trouble getting the budget deficit popularized with some fiscal conservatives. And there also are geopolitical tensions that are once again on the rise with Russia and Ukraine. So not all is rosy for the administration. But when I think about the recession warnings and some of the recession articles that were coming out over the last couple months, they're not based in the current economic data. which is still showing signs of pretty strong growth. With that growth, what you end up getting is a market that on the front end of the curve prices out rate cuts. And those rate cuts that have been priced into the market, they are getting priced out of the market. So in this chart, what you see with these orange bars is at what date the cuts in the market are getting priced in. So look to the left side of your screen. And when you see that negative 1.0, that is when the orange bar crosses below, that is when the market believes that the Fed is going to cut one time. So if you go to this line of 2, what it's telling you right now is that the Fed is not expected to cut 50 basis points until January cumulatively. So we are already in June, and it's telling you that there might not even be a single rate cut this year, potentially. And if that is the case, remember, we have to go by probability distributions. So if there's a decent chance we don't get any rate cuts, you have to sell some treasuries and hide out in money markets as those yields kind of catch up to where the market is, especially on the 2-year part of the curve. All right, let's take a look at those 2-year yields. What you see still on the chart, looking back 5 years, there's still a rolling over of these yields. Now, remember what you're hearing in the media. Hysteria on the economy, that it might be going into recession. Hysteria on the Treasury market, that the fiscal deficits are out of control. Yet you see Treasury yields still rolling over a little bit. It still warrants the price is truth narrative applied to Treasury yields and expectations on the Fed, expectations on growth. And what you see here is that an expectation of inflation over the next 2 years that would warrant an escalation of Fed hawkishness, thereby rate hikes. There's no evidence of any of that in this chart. So it is important to zoom out a little bit. We see the yield hit 5% in early 2023, late 2023, and early 2024. We are a full 1% away from those yield highs. So that should tell you something, and it's something that we are trying to derive. I shouldn't say try. We are deriving a lot of signal from that. Now, going to the 30-year yield, this is the opposite end of the yield curve from 2s that we just covered, and you don't see that rolling over. In fact, you see the yield steadily increasing. And with 30s close to 5% and right up against the highs of the last couple decades, there are some worries about the way that the yield curve is steepening. We believe that this is a natural and healthy steepening of the yield curve because it's pricing in growth between the front end and the long end. Now, that upward sloping yield curve is a sign of health. And what we are starting to discover is that with that 2-year yield that we've shown you, between 4 and 5% for the better half of 3 years now, the economy has not entered recession. And if that is the case, it means that perhaps 4 to 5% is a natural interest rate that leads to a healthy economy. And if we are to say that 0% rates are a sign of an unhealthy economy, then it is sound logic to say that 5% rates are the sign of a more healthy economy. And if the front end is at 4 and the long end is at 5, that upward sloping curve, again, we'll look at the stock market. The stock market isn't suddenly going into a bear market because 30s are at 5%. Stocks are on the rise and steadily so as the yield curve has steepened. So ignore what the financial media is telling you. Look at prices. Stocks doing well, the yield curve steepening, and the Fed basically saying that we don't see inflation as a worry and we don't see a recession as a worry. So we're basically getting the cuts that were starting to get priced into the market, we're getting all of that out. And when was the maximum amount of rate cuts priced into the market? It was just before the fall of 2024 and the end of the election cycle. So there was a bunch of uncertainty going on in mid 2024. All of that has gone away. And speaking of the steepening of the yield curve, here's a chart to show you there over the last couple years. The 5/30s yield curve has gone from almost negative 50 basis points to positive 100 basis points. So that steepening of about 1.5%. That is that inversion going to positive slope, and that steepening of the yield curve. That is what we see as the health. Remember that yield curve steepenings, they usually occur on dramatic rate cuts and a recession. And in a recession, dramatic rate cuts are necessary to stimulate the economy, and that physically re-steepens the curve because the front end of the curve falls in yield. In this scenario, we're seeing a bear steepening of the curve, a mild bear steepening, but yields are rising, and they're rising a little bit higher in the long end. So it's not a steepening because front end yields are cratering. That is typical of a recession. We have not seen that this time around. It is very interesting. The yield curve has potentially lost a lot of signal that it used to carry as a recession indicator. That's something that we have potentially missed and are trying to improve our framework to account for, yes, that the yield curve potentially, for a lot of reasons, but has lost a lot of signal. Quickly on the economy, ISM manufacturing printed today, the first business day of the month. This is the highest signal economic indicator that we have. You see that the indicator came back once again below 50, 48.5. So this is below that 50 line, slightly above the 47 line that we usually see the U.S. economy broadly slip into recession. Remember that manufacturing, yes, it's only a smaller portion of the economy than services is. With that being said, the U.S. economy is not out of the woods. This recession indicator that, or I should say, the recession watch that we've been on for the better part of the last couple years, it's because this ISM manufacturing has been below 50 for the better part of the last couple of years. So it's not like the U.S. economy is booming, and we do need to take all positive data with a grain of salt, especially here seeing ISM manufacturing slightly still in contraction, and the only thing really ticking within the sub-indices of manufacturing, prices paid. Let's take a quick look at the gold price over the past 5 years. Gold experiencing a little bit of consolidation over the last 1 month, but still looking very, very strong, right below all-time highs that we're trading right around between the 3,400 and 3,500 level. You see gold here exhibiting a lot of strength. We are in the middle of a monetary reset, ladies and gentlemen. It's very important not to forget that. Now, I saw a clip of Jerome Powell discussing the end of Bretton Woods. I watched that clip. He was not talking about this year. He was talking about the early 1970s, the Nixon shock, and the floating of currencies versus each other in 1973. So that's why people are calling the current renegotiations and monetary reset Bretton Woods 3. It's not Bretton Woods 2. Bretton Woods 2 was between 1973 and theoretically today. Bretton Woods 1, 1944 to 1971, 73, and we know that until 1958, so the first 14 years of Bretton Woods 1, currencies in Europe were not even convertible to each other, so without express permission of the government. So the Jerome Powell was not talking about the end of Bretton Woods 2. He was talking about the end of Bretton Woods 1. The end of Bretton Woods 2 is something that we see on charts like this and elsewhere. A key component of the administration's plan to get inflation down is to pump more oil, both here and abroad, and get that global oil price down. You can see oil in the low 60s, and the price really not showing any life, and I'm sure that the administration is at least happy about that. The last chart that I have for you today is the US dollar. You see the dollar with a big drop during the first part of 2025, and this is on the back of a global monetary reset, a reordering of trade relationships. And in that reordering of the trade relationships between the United States and the rest of the world, we see the U.S. emphasizing time and again non-tariff barriers to trade, which specifically and number one on the list include currency manipulation. So we will see, as part of the deals that will be announced throughout the summer between Treasury Secretary Scott Bessent and his counterparts in Asia and other parts of the world, that countries will commit to not manipulate their currency cheaper or have mechanisms for the U.S. to police that type of currency manipulation. In that spirit, the dollar is selling off versus those other currencies as investors are anticipating more regulation by the United States on other countries for currency manipulation tactics. Please subscribe to the channel and rate and review. Subscribe on your favorite audio platform. If you guys want more in-depth research, reading along, and getting that quantitative edge for your asset allocation at home, thebitcoinlayer.com/subscribe. We'll catch you guys next time.